Now it is my honor to introduce today's moderator, Andrew Dickson. So come on up to the stage. So a bit about Andrew Dickson. He's Director of Leasing at Oxford Properties. He's got a wonderful depth of knowledge in both agency and principal roles in strong and weak markets. That's given him really a great and unique perspective that he'll be sharing today, and I'm sure he'll be grilling the panelists. He's successfully completed complex transactions, delivering consistent results and outcomes in the most challenging of markets. In his role as director, he is responsible for leasing Oxford's office portfolio in downtown Vancouver. So without further ado, please welcome Andrew Dickson to the stage.
Good morning, everybody. Thank you, Paula. I'm really excited about this morning's panel discussion. We've got a great panel with over 90 years of experience collectively, so these people have seen a lot and been through a lot. For anyone who's been not paying attention or been living under a rock the last few years, the office market has been going through a period of massive disruption and uncertainty. On any given day, you can pick up a newspaper and point to an article that's outlining the imminent demise of the office market. My personal favorite of the last few years was having been told I was living on Mars and that there was an impending apocalypse coming for me and my office market friends by an unhappy tenant. We went from a sub 3% market in 2020, feeling like the good times could never end, to an existential crisis with the onset of COVID. And yet, through it all, Vancouver's office market continues to be one of the most resilient in North America and one of the strongest and healthiest in all of North America. And we're just outside of what many deem to be a balanced market. And so while there's real challenges to face, there's still a lot to be hopeful about. So I think as we get into this discussion, there is a lot of green shoots and silver linings that I think are worth talking about. So before we get into our panel discussion and invite our panelists up on stage, I'd like to kick off our discussion with a audience poll question. So if you could all indulge me and take a look at the question on the screen and let us know how many days a week you work in an office. So please go ahead and text the number on the screen. In order for this to be a reliable poll, we're going to need lots of participation, so we'll just take a couple minutes. So while you guys are pinning that in, I'll start introducing our panelists. Gardner of Avison Young is a principal at Avison Young with over 17 years of experience. He has a proven track record in both strong and challenging markets. And in spite of significant headwinds, he was recognized in 2022 as AY's highest producing broker in the entire country. He's a diehard Oilers fan and a decent golfer, so please welcome Glenn. Next up, we have Kevin Nelson. Kevin holds the prestigious title of Vice Chairman at CBRE, which he has rightfully earned in a 30-year career in commercial real estate. He's built a business and a reputation as one of the city's go-to guys for tech tenants and is a founding member of CBRE's high-tech facilities group. Beneath Kevin's calm and steady demeanor, he's a full-blown, thrill-seeking madman. Just ask him. Next week, he's planning on navigating the Atlantic Ocean, trying to cross over to Europe. It's not as though you don't have enough gray hairs, Kevin. Next up, we have Janay Koldingnes of Edit Studios. Janay is the founder and visionary behind Edit Studios. With over 2 decades of experience in interior design and branding, she's worked with major companies such as Lululemon, Trulioo, and Oxford Properties. Janay and I also hail from the same province. That's the one that's easy to draw and hard to spell. Jarvis Rouillard Jarvis is a partner at PCI Developments and is responsible for all aspects of leasing, acquisition, asset management strategies. Jarvis is completing his 9th year on the board of directors at NAIOP, having served as president and national director. Please welcome Jarvis. Okay, so quickly back to that poll question. Glenn, what were the results of the work from home strategy? How many days a week are people in the office on average?
Well, I have to go through 98 text messages, so.
Yeah. Well, while we're waiting on the results of the audience poll, we'll kick it over to Kevin Nelson to take us through a brief market overview.
Hey, good morning, everybody. I'm Kevin Nelson from CBRE, and thanks for letting me bend your ear this morning on current market. I promised my business partner, Blair, and for good reasons, I guess, that I would keep this as brief and riveting as possible because A, Eli has mildly undiagnosed attention deficit challenges, and B, stats can be granular and, quite frankly, get boring pretty quickly. So with that, I'm going to put on my glasses, actually. Glenn, what do you say about glasses again? Well, that was kind of it. I think what you said was that it gave you a plus 40 on your IQ through your career, or at least the presumption of it, and that's how you bluffed your way all the way through your career. So I'm gonna bluff my way through some stats with these glasses on right now so I can hit my high points. Okay, chart on the left, 16 years. You're gonna see the vacancy line, the availability line is the top line. So you're gonna see a spike in vacancy as we hit the credit crisis, 08, 09. You're going to see a spike in vacancy as we hit a delivery cycle of new buildings in 2015 that was higher than the credit crisis. And then what I'm going to focus on is I want to tell the story of the last 4 years, so the expanded view on the right, because quite frankly, we have been through a lot, and it's been pretty crazy. So 4 years ago, we were in a market that was ridiculously tight. It was 2.2% vacant. It was the tightest market in North America. Please note that, Paul Tilbury, as we yeah, points coming. Tightest market in North America, and if you were a large tenant, you were in trouble. You couldn't find space. There was like 3 spaces at any given point over, let's say, 40,000 square feet. So you were forced into, which was great for the new development cycle, but you were forced to pre-lease into this development cycle. The only problem was it was 2, 3, 4 years out. Then you had to go hat in hand to your landlord. Some would participate, some wouldn't, but they would give you an extension short-term to bridge you through to the new development, or you'd end up in WeWork. And WeWork was the greatest story of these panels for every year up until 2020. And WeWork was in its golden hour, just like big tech was in our city. They were up to 9 locations, about 700,000 feet almost. And that's how the market was functioning at Q1 of 2020. We all know what happens end of Q1. COVID, you can see the corresponding spike in both vacancy, head lease, and sublease immediately. Basically, I don't know about you, but work from home forever. The office is dead. I had a crisis of identity. Had my career just evaporated. So, we watched a nuclear winter of escalating vacancy for the next 2 to 3 quarters till we got to the end of 2020. But by the end of 20, all the federal stimulus, both in Canada and abroad in the world, started to show up in the equities market. And it really started to show up with venture capitalists. And so the money just started getting loose really quick. And it drove a ton of venture cap deals into both small and mid-sized tech in our city, which really drove this hyper expansion mode in our city, along with big tech was still going back for some expansion. The world was still spinning, we had a vaccine, there was optimism, and you can see the corresponding drop in vacancy. Subleases go first, as they always do. They're cheaper, they're finished, they're furnished, they're faster. But then the head leases started to drop, and quickly the market got imbalanced again for finding large spaces. So it was a return to the new tower development cycle, and a lot more large deals got done through 21 and then into 22. But by the end of Q1 2022, we've hit our lowest vacancy, 7.7%, down from 10%. We'd recovered pretty good. But then the end of quantitative easing is basically announced. Inflation concerns drive successive interest rate bumps. The stock market shows concerns now for inflation. The VCs are now telling their investees, that's it, you get no more money this year, you got to stretch it out, make it last. And it was announced as the end of top-line growth in big tech. Effectively, you had to do more with less, you were no longer hiring people, it was all about bottom-line growth. And all of us office leasing brokers and landlords were once again watching as market concerns and successive bumps caused vacancy to actually spike to its highest level, not quite as high as the tech bubble in the early 2000s, but higher than the great financial recession, higher than COVID, higher than the development delivery cycle in 2015. 11.8% presently. Hey, Paul Tilbury, it's still the lowest vacancy in all of North America. Vancouver continues to do what it does. It seems to defy the rest of the world. Best city on the planet to own office in. Time to buy. You're buying. Okay, next slide, please. Okay, sublease availability. The black line is the number of subleases. The bars represent the square footage available. You're going to see we're at 100 subleases downtown right now. We were at 149 during COVID, so it's actually a smaller number, but the square footage is higher. On average, the subleases are bigger. We're at about 1 million feet available right now, and at its height, it was only about 770,000 during COVID. So many of these subleases have been sitting for a while, which is leading some offerings to be at discount, which is driving attention. And this is causing some landlords to now reposition their options in order to compete. So turnkey offerings are now what's being accomplished on blank spaces, increased tenant inducements, delayed commencement dates to provide some form of free rent to clients. The face rates might be still holding, but they're under attack and certainly at risk of dropping and under pressure, but the net effective rents have certainly dropped over the last 2 quarters. Where's Lou? Lou, sorry, Lou. The shield of 4% portfolio vacancy with Cadillac, or less than 4% vacancy, is under siege by the rest of the market. You heard it here. Next slide, please. All right, this is just the stack of what's available by size, sublease and direct in downtown. Bulk of it is under 5,000 square feet. The point I want to make again is that above 20,000 feet it gets scarce. Above 50,000 feet it's really quite scarce. And this has again been driving interest in the new towers that are still delivering. I know that there's good activity in places like VC2 and stuff right now as well. So, and an interesting side note to this is that there's actually 168 full floors available downtown right now, only 45 of which are subleases. So, next slide. This was our development cycle, 2021 to 2024 deliveries. Represented 3.7 million square feet, or a 12% increase in the size of our downtown market. It was doing really well through it was doing excellent through 21 and 22 and prior to that, because it didn't have a material detrimental effect to the vacancy rate in our city that we're experiencing now. 86% of this was effectively pre-leased. And what's incredible is that 3/4 of those pre-leasing commitments was net new absorption. I mean, that was only 18 months ago. How much do we miss just nothing but a marketing growth mode? Like, it's going to make me cry. But yes, thank you. It should also be noted that that number, that absorption number, 86%, would have been higher if it wasn't for Glenn Gardner here already moving sandstone out of VC2. Sandstorm. You're the worst, man.
Doesn't even work. No.
Next slide. All right, this is regional vacancies, suburban versus downtown. The light line is downtown, the dark line is suburban. The blocks represent when towers were delivering to the market. There's a few things I want you to note about the suburban market. In the last 4 years, it has effectively been constant, and only in the last 2 to 3 quarters has it started to rise. You'll see that the delivery of the buildings, although that looks like they were jumping vacancy up, that really corresponds to the rise in all the subleases that were happening downtown. So not a material jump in subleases. At 7.2%, this market, the suburban market, is only coming into balance presently, although we are hearing rumblings of maybe a couple other large blocks, but story evolves, and we'll check in on that couple more quarters. Next slide. This was our 2026 to 2029 development cycle, another 3.8 million square feet downtown. Every single development has been parked right now, or requires a significant pre-leasing in order to kick it off. And unless someone in this audience wants to tell me I'm wrong, nobody is building on spec right now. So here's your chance. Anyone want to defy that? No big announcements today. Okay, well then the point of that is that in 3 to 5 years with no new supply, when the market's turning again, and we only got up to the lowest vacancy in North America, Paul Tilbury, the recovery downtown is going to be rapid fire. And in the interim, what we're going to watch is we're going to watch subleases, high quality subleases will always go first. They do in every market cycle, lagged by sort of homogeneous, non-special spaces. But the recovery is going to be quite quick. And last slide. Just a sampling of what's on the market, sort of largest available subleases, suburban and downtown. Having said that, there's action on a couple of these things, and this story might evolve in the next 2 weeks to 4 weeks. And there it is again, Glenn, sandstorm.
Still there.
So, you're the worst. Anyways, that is your market update. Thanks for the time. Any questions?
Thanks, Kevin. Thanks for setting the table for the discussion. I kind of want to turn our attention to the return to office. It seems like over the last 3 years, there's been so many fits and starts with return to office that work from home and hybrid policies really have become culturally entrenched and harder to fight against. So with that in mind, Glenn, would you say that return to office is dead? Has it plateaued? Or is it picking up momentum?
I think it really depends on what industry you're in. I mean, the legal industry, the accounting industry, a lot of our clients, they've been back for 12, 24 months already. The mining industry is obviously very active. All of our mining clients require their employees to be in 3-4 days a week. The technology industry is still having a struggle with getting people to come back and come back in a meaningful way. However, depending upon what happens over the next 12 months, if the labor market gets tighter, you might see that change a little bit because, I think the thought is, well, if you fire me because I'm not coming to the office, well, I'll just go work at SAP or any other technology firm. But if that's not an opportunity, you might have to start coming into the office.
Can I add?
Yeah, go for it.
I've got a glass half full answer for sure on this one. I feel like the debate of return to office that sort of plagued decision making of 21 and 2022 is nearly over. Anecdotally, we can all see it, right? The elevators are got people in it, the parkades are full. There's even new food services opening up under Bentall Center, so it suggests that people are back. But the landlord's numbers back it up. So in speaking with Lou Fuccicelli at Cadillac, and I spoke to Peter Jenkins at GWL, and Chuck Wee at Hudson, and yourself, Andrew, at Oxford, the 4 big landlords, your numbers would suggest on occupancy that you're within 10 to 20% of your pre-COVID occupancy numbers. So it's happening. And then a recent CBRE study that we did across our platform between sort of checking in on types of work shows that hybrid and full-time work presently represent 90+% of companies. So that means work from home forever is less than 10% presently. And I have a couple really interesting perspectives from across our platform I want to share. In our 2023 Tech Talent Report, CBRE surveys 250 tech companies. And they found that one of the interesting finds was that the rate of employee turnover is a 2x with a fully remote company than it is with a hybrid company. So some good evidence as to why employees even want to be there. I was personally aware of 3 clients who fired or hired their service providers based on their return to office policy. So there's pressure from clients building. That Vancouver has a more agreeable workforce than other cities, which allowed clients to have a custom sort of return to office strategy. Vancouver versus San Francisco might look like 3 days in San Francisco and 5 days in Vancouver. Same company, that's one of my clients. Then my team, and we get to crowdsource hundreds of companies each year, but we never heard of one employee mutiny because an employer ever said you need to go back to work. Then in hyper-competitive tech spaces like artificial intelligence right now, they're in 5 days a week in San Francisco. And in fact, some recent Silicon Valley fundings the money's been tethered to minimum return to office metrics. So that is, if you were a leader and you were concerned about changing the narrative at your company before, not only of the examples of Elon and other big tech sort of helping to pave the way, but you now have clients and financiers in the mix having an opinion as to how businesses should be run. So the office is not dead. This is fantastic news for us all.
Yeah, that's great. And I mean, Jarvis, do you have anything to add with your portfolio? Are you seeing occupancy rates rise in your developments?
Sorry, is this, yeah, it's working. Yeah, I absolutely agree with the other two. I was just in Seattle last week for the NAIOP Converge conference, which I'll give it a plug because if anybody hasn't been to that, it was really, really well done. It rotates around North America. And before that, they had an office symposium for the morning, and so they called a lot of the large office landlords from West Coast North America there. And I was prepared for negativity, but it was like really dire. It was shockingly dire. So when I kind of spoke a little bit of that, I mean, it was, bringing a Vancouver lens to it. To your point, Vancouver's outperforming, but there was a guy from CoStar there who talked about return to work has already happened. So if you're banking on more return to work, I think they were talking about 60% office days in the office, or days in the office, hitting across US wide. It's done, so that's it, and everybody, all the landlords were depressed. But I totally agree. I think there's 10 to 20% more coming. But really, I mean, if you're planning your investments going forward, planning it based on a full return to work, it's more of an economic thing right now, and that's what we were debating is it the economy or is it return to work that's causing kind of some of these vacancy stats? I believe it's predominantly the economy. It's lack of capital, it's lack of growth for companies. That will change over time. And so I think that's kind of where we're looking at our investments going forward.
Great. Well, that's encouraging. Expectations have also changed over the last few years, not just with clients, but what employees are asking of their employer. And I guess the question for you, Janay, is how are workplace designs evolving to meet these new criteria, these new demands from employees themselves?
So 2020, 2021, our industry called it the Great Experiment. And get your mind out of the gutter on that. It was just throwing things against the wall, seeing what sticks, C-suites, all the different companies. Nobody had the silver bullet to tell you what each company needed. 2023, the stats are in. We're starting to see what's tracking and what's not. I think the biggest surprise that we've seen is the idea of privacy and acoustical privacy. So with all the interviews and engagement with these companies, so many people were saying, I don't want to be in an open work environment. I don't want to be disrupted. I want quiet, heads down space. And if you are put in an open work environment, is my sound okay? If you are put in an open work environment, the expectation is that you're provided phone rooms, quiet room, meeting rooms, heads down spaces where you're not being disrupted. So that was the top trend that we saw coming out of 2020 and 2021. We did a big survey for a larger client in 2021, and they asked their employees, what kind of work point do you want to be in when you come back? 80% of them chose this god-awful picture of this cubicle. It literally looked like a cubicle from the 1980s government buildings. And the leadership nearly fell off their chair when they saw this. They could not believe that that was the sentiment. And so I think the point of it, though, we're not going to design people into government-style stations again, but I think the point is we have to be more cognizant of these private spaces, these contemplative spaces. We're designing a lot of libraries and phone rooms and reading nooks. That's become quite popular in people's office these days. Shared office spaces has become quite popular, meaning if you're only in the office 3 days a week, then your office goes to the market and somebody can book it when you're not in. So we're seeing a lot of that in accounting firms and engineering firms. The other ratio that changed that was really surprising was what percentages that we design with. Meaning, 10 years ago, it wouldn't have been uncommon to have planned with 70% me space, 30% we space. Wasn't uncommon. Now I would argue in certain industries, tech in particular, that's been flipped, completely on its side, and there's much more space being allocated to amenity space. Yeah.
That's great. So I feel as a landlord, the landlord actually has a big role in driving return to office. There's lots of initiatives that certain landlords are taking, but I guess I would turn it to you, Jarvis. Like, what are some of the really important initiatives that landlords can do, or successful landlords are doing, to help earn that commute, to help make it easier for companies to attract their tenants back to the office?
Well, I would say, I guess I take this with a grain of salt because I'm one of the landlords sitting with a half-vacant building. So we're still trying to lease that up. So some things work, some things don't. But I would say the three things that we're focused on right now that has been working, and we've had significant progress on that lease-up program in the last 6 to 8 months, is one is security. So security across all our buildings, I think, you know, it was an issue during COVID in Vancouver, but when I was down in the States again last week, I mean, we literally had people, they had the mayor of Seattle, his COO was speaking, and we had landlords standing up and screaming at him because they were furious at just the lack of progress in downtown Seattle. We don't have that problem here. We're very lucky. It's not perfect, but it's improving. And I think that's partly because we have a mixed use downtown. We have a vibrancy that's back to a lot of the reasons that Kevin said. People have been ready and willing to come back. We don't have the big commutes in some aspects that other cities have to challenge with. But we're focused on security. Let's get people back into the office. Let's have them feel safe. So we've had 24/7 lobby guards, things like that, put into some of our higher quality buildings, which has helped, and it's actually secured us a number of tenants. And then collisions, which is huge. And I think as we're designing with some of our partners for the next phase of office projects, collisions is going to be everything. We talk, you know, Janay talks about space being designed. It's like a lifestyle. I think the other thing is more autonomy within those spaces. And with that autonomy, you're battling the commute. People want to collide with not only their colleagues, but also people from other companies that are in that building. So we all know it, but that's really a focus that we're taking on as we design. And then also timing. At the city of Vancouver in particular, and other cities we're seeing, including Surrey, permits are taking way longer to get approved. So in some aspects, in some of our buildings, we're going in for permits for kind of, you're guessing in a way, but you're basically going in for TI permits on a number of floors, so that if tenants want to take that TI permit on, they're saving a lot of time, and they can go in for amendments versus going in and going through the entire planning process, and that has worked in some cases in our favor.
Nice. Yeah, so, I mean, Kev, Glenn, you guys are touring around the city, you're walking different tenants through different buildings all the time. Is there something that you see, you know, successful landlords are doing to drive return to office that maybe others aren't seizing the opportunity to do?
You know, it really comes down to amenities now, and that's it's kind of the case for a long period of time, but not just a gym, but real gyms. I mean, kudos to you, the building you guys just built has a real gym. You can use that gym instead of going to any other kind of fitness facility. Conference rooms, cafes, restaurants. You know, if you're going to get employees back into the office, and we were touring a big international tenant earlier this week, you literally have to check every single box that they want, or they're just not going to look at your building. And so most of the landlords have done a really good job of making sure that the amenities within their portfolio or within their building checks all of those boxes. And not just, hey, it's a gym, but it's a real gym. It has the towel service, it has the showers, it has a place where you want to go, because they're trying to get them back. And may not be all day, but if somebody can come in, use the gym, work for 5 hours, 6 hours, and go home, that's a win for a lot of employers today. So I think it's really about having those high quality amenities, which, again, kudos to most of the landlords in the room, because they've done a really good job of doing that.
I'm just going to quote Andrew Dickson directly. He said, "We're no longer in the business of leasing space. We're in the business of creating an environment where people want to come to." And you're helping the employer do that as well. So the entire buzz about going to the office is not just an employer's problem, it's the landlord's initiative as well. So
I said that?
you said that, man.
Oh,
I'm giving
wow.
you credit.
Jeez. Must have read it somewhere.
I would also say that the lobby is the front door to all of it. Sometimes you walk into these lobbies and they're just mausoleums. There's nothing in them. And I think landlords have to be 100% focused on how you make that asset come alive. I do think, Andrew, you guys did a phenomenal job at MNP Lobby. I think it's one of the better examples in the city of activating a lobby. And it can be low-hanging fruit. It can be a furniture program in your lobby. It doesn't mean a full renovation, but I do believe that that first experience, it sets the tone for tenants.
Well, I mean, it's encouraging. It sounds like there is momentum towards return to the office, and hopefully we can continue to see that as we get into 2024. One of the other big challenges facing the office market is the cost of construction. We've seen huge increases to the cost of construction over the last 24 months. But I thought it might be helpful to actually give you a scale of the magnitude of change by putting a few slides up here. So we'll kick it over to Janay to talk about that.
Okay, so for the past 2.5 years, overall, construction costs have gone up by about 35%. This chart on the right, while hard to look at because it's small, just shows commercial buildings in the medium-rise sector and how they compare to the other asset classes of other buildings. So on the low side, you've got $240 a square foot up to $335 a square foot in Vancouver during 2022. We can go to the next slide. So drilling down into TIs and where we're seeing those changes. So before COVID and the years leading up, we could get paint and carpet for around $10 a square foot. Now we're at about $15 to $25 a square foot. On the furniture, we used to be able to do furniture for $20 to $25, and now we're seeing that edge up to the $30 to $45 a square foot range. We can go to the next slide. Fun fact, did you know that an interconnected staircase, one level, starts at around $400K and only goes up from there? And that doesn't include restoration clauses. So anyone with a deal who's doing an interconnected staircase, AKA sandstorm, be very careful because it can really mess up your budget and the lead times. On the TI side, on the low range, we're seeing anywhere from $125 to $150 a square foot, which is kind of your bare bones. Basic walls, basic infrastructure, maybe reusing infrastructure, a bit of upgraded lighting. This is 7,000 square feet and above. And then we can go to the next slide. On the mid-range, we're seeing $160 to $200 a square foot. You're getting more bespoke finishes, you're getting more build-out, new lighting, new ceilings. We can keep going. On the high range, we're seeing $200 to $285 a square foot, and we have seen some deals this year that are over 300 square feet. So we're definitely edging above that 300 mark. So I'm going to date myself with this stat, but for the majority of my career, and I'm sure there's a lot of others in the audience, we could get a deal done and constructed for $60 to $80 a square foot. Do you guys remember when those were the golden days? I think our new golden day number is 180 to 200 and possibly more.
Yikes.
Just a quick snapshot of where those costs are going. So this is showing 64% are hard costs. I can't actually read that slide. 10% is contingency, 15% is FF&E, and 15%, I think 13% is soft costs. So just an idea of how it's breaking down. Why is this happening? So costs in the labor market are going up, traditionally labor-intensive trades, so drywall, paint, carpet, and the reason for this is their wages are going up, inflation's going up, and we don't have enough of those trades. There's a shortage in those industries, and they're not entering these fields fast enough. Metal leveled out after COVID, wood has leveled out. And then on the procurement front, I think we all have to watch mechanical, anything mechanical related, fan coils, heat pumps, rooftop units, lighting controls, lighting are long lead time. So word to the wise, if anyone has any of those things, maybe go direct to your trades on those to make them work with your timeframes. And then last slide, which I thought was really interesting, Turner Construction actually polled their trades and asked them what their pipeline looked like for the next 6 months. And 78% believe that the market is steady and they have more than enough work. 22% said they were saturated, and 0% said that they were not busy at all. So I think it just says to us that costs aren't going down anytime soon.
Right. And I mean, in an environment where rates are flat or softening, construction costs are rising as steadily as they have, broker fees have gone up, hooray. How do landlords rationalize some of these deals? Jarvis, how do you make sense of a deal where you may not make money on a term of 3 or 4 or 5 years?
Yeah, I mean, I think it's all about looking at the competition in the market and time value, which is a no-brainer. But and I think one, you're you're trying to fill a building, so you're looking at the alternatives. But also when you're looking at investment dollars, even when you're looking at kind of spending money on retrofitting a building, I think too, you're really looking at where are you going to spend on retrofitting a building and looking at dollars in terms of leasability, ESG, otherwise, versus getting the building full. And so it depends on what your situation is. But right now, I mean, if you're in a building like one of ours where you really need to fill that building to make it work, you're taking kind of your pot of money and shifting it to let's focus on getting deals done.
Right.
And you might be taking that capital from other buildings that are stabilized that you might be normally retrofitting or spending other capital projects on. You're allocating dollars in different ways depending on the situation.
Many people in this room may or may not remember, but negative NERs are a thing. They happen once in a while, right? So,
Talk to the guys in Calgary, right?
yeah.
Yeah. I mean, how are the construction costs impacting tenants' decision making? Like, are there scenarios where you're seeing tenants who say, we'd love to move, but A, we can't get the tenant improvement allowance from a different tenant, or we can't build out the space we want? Glenn, how are these costs impacting tenants, and if at all?
Again, I think it depends on who the tenant is, but I think the bigger issue is timing, right? Tenants aren't leaving themselves enough time to go through the entire process with how long it takes to get city permits and how long it takes to get the trades involved and how long it takes to build. And, timing seems to be, a big piece of it. And the capital costs. I mean, Kev talked about, the capital is not as readily available as it used to be. And I don't really see that changing anytime soon, but kudos to a lot of the landlords in the building because they've done a good job of trying to offset that as an excuse to not leasing space in their buildings and going ahead and either turnkeying the space for them, putting the risk on themselves, or alternatively, providing allowances that are far above than we've ever seen before. I just did a deal with Sean Keenan. I did a deal with Sean and Allied, and every turn of the excuse of why we couldn't do it, they responded in kind, and then essentially they're going to build us out brand new office space, and all the risk is on them as the landlord, not on us as the tenant. And without that deal probably doesn't get done. So, tenants are definitely turning to the landlord to take on that risk as opposed to the other way around. But, there's a lot of landlords in this room who can't do that. Their structure is not set up in a way to take on that risk, or they're not set up in a way to take on a project. And
So what's your advice to them? If the cost of financing these improvements is prohibitive, if they don't have a fitness center, that financing that is prohibitive, what do you say to a tenant or an owner of a B and C class building in an environment where its financing is constrictive and there's a flight to quality? How do they compete?
yeah, and I think flexibility is really the big piece of that at this point in time. The B class and C class tenants don't necessarily have the foresight that an A and AAA tenant that do. They may not be as big either. The more flexible a landlord can be today, as an example, an option to terminate, an option to expand, an option to downsize, all of those play a massive factor in a tenant's ability to act quickly and or actually transact on it. The other thing that B and C class landlords have that a lot of other landlords can't work with is they're prepared to do shorter term deals. If you're an existing tenant within a B or C class building and you don't know what the future looks like, most of the landlords will sort of ebb you along and get you to 2 or 3 years so that you can make that choice. Most tenants aren't going to leave because of a 2-year term. So I think there's a big piece of that in the equation. Pricing, at the end of the day, pricing is always going to be a factor. We've had certain clients of ours who are in B-class buildings, and the landlords have come to us and said, well, what does it have to be? Just tell us the number, let us make that decision, and if at the end of the day we can't get there, you can leave, but at least give us that decision on pricing. And I would say most of them have responded in kind, and they realize that pricing has changed, and they're prepared to go to that level in order to keep them in the space. Jarvis alluded to it, but spec suites is a massive one. If you have a B or C class building, and it's difficult to do on a large scale, but on a smaller scale, if it's a 2,000 or 3,000 square foot unit, if it's built out, ready to go, some instances with furniture, and the tenant can just walk in, that makes it really easy for them, right?
You're competing as if you're a sublease, and subleases win the moment for the next couple quarters in this kind of market. because you avoid the timing, you avoid the cost, and you avoid the being pushed into a longer-term deal. So this is why all landlords should recognize they're competing with the sublease market now. That wasn't the case maybe a quarter or so ago, but I poke fun at Lou, but he's net effective rents are dropping as a result of this.
The show suite thing is fascinating to see what's happened this year. It's been like a competition between landlords to see who's going to build the best show suites. And obviously, Jarvis, you have the most experience with 7 floors of it. But
Losses. Some wins, some losses.
Wins and losses. But what we're seeing is like, it wasn't, we used to do cold shell, then we did warm shell. Now people are throwing up walls, and it's not enough anymore. They have to furnish it, they have to style it. It's like you're selling an image to a tenant, you're selling an idea, and they want to see themselves in the space. So it's been fascinating to watch each landlord have their own program, and I think it's just only going to get more competitive.
I mean, I would throw it back to you, Andrew. I mean, you guys build show suites. How well do those do next to a space that's not improved?
Yeah, I mean, it's pretty easy to rationalize the cost because you just see how much faster it leases. We've done 1 floor in Guinness Tower where we switched it from a full floor offering to demised it into 4 suites. We haven't even gotten the trades off the floor, and we've got 3 of the 4 conditionally leased. So we're just going to continue to roll that program out. If you don't build it, it will not move. I mean, that's the environment we're in, so you just have to figure out how to rationalize the cost.
Well, and I think the other thing that you asked this about the build-out costs, a lot of our larger clients have no issue building out new space. In fact, they want to build it out. They want to spend the money. They want to invest in that because they actually want to tell their employees, hey, look, we're delivering you a brand new office, brand new improvements, fully functional, ready to go. So they're actually doing quite the opposite. They don't want to stay in their old space. They want to go and build out brand new space, and they understand the costs of it.
Yeah.
Can you tell the audience the wins and losses of show suites and sizes? Because I feel like we know that now.
Well, yeah, I mean, at 601 Hastings, we built out a number of floors, and there are about 9,100 square foot floor plates. And there's been, I mean, and when I say losses, they're not losses. We have successfully leased, by building out those floors, we've secured tenants for a number of those floors. But there has been one in particular where we built the floor out, and a tenant came in recently and absolutely wanted that floor. It was one of the last few floor spaces. And so we ended up making the decision to mothball that floor. And some of it will get used, but we also gave them a significant TI. So to Kevin's point, in that certain specific instance, it was a great covenant tenant. It was a multi-floor deal. It was just creating continued momentum for our leasing program. So for a number of reasons, it made sense to do. Would we do that deal again as we continue on the leasing program? Maybe not, but depending on the tenant. But it was part of that program. And so the challenge with doing it for multiple floors, and with those floor plates, they're a little more difficult to demise than, say, Guinness Tower. You can demise into 4. They're smaller floor plates. I think for 3,000 to 5,000 square footers, do it all day long. But when you hit that 10,000 feet, you're really guessing as to what that tenant wants, and those size tenants are really looking for specifics on what they need. So for a new shell space, when they're moving to a high-quality building like our building, those types of tenants are finally figuring out, and they still are, some tenants are still working through it, but most of those tenants now are figuring out what they want, and they want specifically built to their standards.
So I'd like to take the conversation towards the demand part of the equation. We cannot recover as a market unless we have demand. Over the last 10 years, tech has really been the driver in this market, and they've taken up the bulk of the absorption. Obviously, tech has slowed down considerably since 2022. So where is the demand going to come from in the next 3 to 5 years to see us recovering? Kev, do you want to take that one?
Well, presently in the city right now, there's more demand coming from financial services and engineering. So you can see that by the requirements out in the market, which is fantastic news. The VC market, while it did turn off, it got really excited about artificial intelligence last winter. And that drove a lot of funding, including to some of our local firms, which is great. But the one thing about AI is that it's ubiquitous. It's going to touch all platforms, engineering, real estate, like accounting. So the integration of this technology into every industry silo is a giant opportunity for local mid, small tech companies as well. So that's fantastic. If I'm listening to my guys in Los Angeles, they're saying post-production's making up for lost time, which of course we'll be a net beneficiary of that one shortly. And then expect some larger US tech to show up again in our city, as San Francisco is actually making a very rapid comeback. 2/3 of all deals done in that region are downtown. 400,000 feet just went to OpenAI. The money's down there. There's a net migration of employees back to the city. But that market, whenever it sort of satiates itself on what it can consume of the local tech talent, we get the benefit of it here in Vancouver. You should all know, and back to Paul Tilbury once more on the positives. The Vancouver ranks 8th in North America's the top tech cities, top 50, and that's because livability, quality of worker, and relative cost to US dollars, and San Francisco's already paved a way into our markets. So San Francisco's firing. We get more in Vancouver from San Francisco than we do from Toronto. So that's where demand's coming from.
Glenn, where are you seeing the demand today? Is it in the large block, the small block? Is it A class, B class, C class? What's attracting tenant attention right now?
I mean, it's kind of been the same story, even if you go back to 2008 and 2009 during the economic downturn that we saw then. The view premises in our city always seems to go first. You look at every new development, all of the view premises are gone. You look at all the available subleases, all the available head leases, primarily none of that is in the view premises. So that space has always been in demand. I think it's always going to be in demand. People want to look at water and mountains. And that's not going to change. Where we're seeing, it'll be interesting to see, because where we're seeing the dogfight in the market right now is really in that commodity space, right? The 14th floor of a A-class tower. You talk about 168 full floors available. I mean, we should dive into the stat on that, but I bet you 60% of those, 70% of those are in that commodity type bracket. And that's really where you're seeing a lot of landlords compete really, really hard. It'll be interesting to see how, or if the new tower landlords, if they begin to compete a little bit stronger than they have in the past. I mean, you look at what's left in all of the new towers, and again, it seems to be the bottom third of those buildings. And if you add all that square footage up, it's quite a bit. So it'll be very interesting to see if they begin to compete a little bit stronger than they have in the past. And then, good quality subleases, right? You got to Kevin's point, you have to compete against them. And, to plug Sandstorm for a second, we have 33,000 square feet of fully built out, furnished.
Boo.
But it's beautiful space, right? Yeah. So inevitably, the market has to compete against that as an offering. So it will be very interesting to see what the next 6 to 12 months hold. But, it's the commodity type of space that is definitely going to be a dogfight.
Okay, well, looking to the future a little bit, ESG, for those of you who aren't necessarily living it each day, it's becoming more and more entrenched in people's vernacular. Everyone knows what ESG is. You look overseas at Europe and you see that, financing buildings, insuring buildings, actually the ability to buy and sell buildings is tied to carbon reduction targets. Locally, Vancouver's put through legislation that will limit emissions from buildings starting in 2026. Publicly traded companies are now having to report on their carbon footprint as part of their filings. So with that in mind, I guess, Jarvis, I'd like to ask you, how much time is PCI and other developers spending considering ESG in their designs, and how much time are you spending thinking about future-proofing your portfolio for what's coming down the future with ESG?
Yeah, there's no doubt. Considerable amount of time. Our teams are working with our property management team, asset management team, and development team working together to, on the new developments first, I guess I'll touch on that. Looking to Europe, but also just looking at capital. All the investment capital that's coming into office that's going to continue to go into office, it's going to require high ESG thresholds, and that's not going to stop. That's going to continue, even with, the cost of capital going up and capital markets tightening. It's going to continue. That's everything we're hearing from everybody we've been talking to. So it's trying to break through the noise as to which types of technologies you're going to adopt, which types of certifications you're going to adopt. Because I think from a tenant perspective, other than the large corporates at this current time, a lot of them aren't, I don't believe, looking and demanding that type of that build out when they're looking for building. They're looking at price, they're looking at amenities, they're looking at other things. And our broker friends here will maybe disagree, but that's kind of what we're hearing. But investment capital into the developments is driving it. And I think that the tenants will probably grow, that will catch up, and it will catch up like Europe over the next kind of 5 years.
Yeah.
So that's kind of what we're looking at. And then in terms of existing portfolio, like I said before, every dollar is being scrutinized right now on office. Do we invest in this office building, or do we invest in that office building, or should we invest in both office buildings? One of the interesting points that came up when I was at this thing last week, a lender spoke up, and she was talking about, and it was a point that really hit home, is if you're an investment advisor and you're putting dollars into office right now, not only is there kind of risk of lease up and return risk, there's also actually business risk right now, because you might actually have redemptions because of all the media that's negative on office. People might get scared and take their money out. So that's an interesting thing that we need to overcome. But yeah, so in terms of retrofitting existing buildings, it's about future proofing, it's about energy efficiency and like operational efficiency or leasability. If there's no business case there, it's an absolute no. And if you're looking at even replacement of roof sections and things, if your building condition report says it needs to be done because it's the end of useful life, you got to be challenging that and going, does it actually need to be done? Is it at the end of its useful life? We're going through all that right now, because if you can defer some of that stuff, maybe that's something that you need to consider at this point.
So it's pretty clear that owners and operators, it matters. It's a big deal. It's only going to get bigger. But I guess I'm curious to know, Kevin, like, does it matter to tenants at the end of the day? Are they basing decisions off any of these investments or designations, be it BOMA, LEED, zero carbon? Doesn't matter.
No.
No.
But we know it's coming. So you're the vanguards. You have to lead. You're going to put it in place. You're going to future-proof yourself, and then every public company, including CBRE, is going to have to make decisions based around a different set of checklists. But this last deal cycle did not really. That wasn't an agenda item at its highest points. So.
I wish there was a different answer on the TI side. I am a LEED accredited professional, and I have been for 20 years, and I have yet to use my designation. On deals, we'll see people come to the table with these RFPs, and they have lovely written acclimates about what they want to achieve in terms of sustainability, and everybody has the best intentions, but when the rubber hits the road, I'd say 9 times out of 10, LEED gets cut, well gets cut, and what we're seeing is people cherry pick. So they'll kind of go across between the two designations and just pick out what financially works for them and what's kind of low-hanging fruit.
Okay, well, I'm just trying to be cognizant of time. We're about 10 minutes out, so I figure we would transition to a few rapid-fire questions. So short answers, we'll try and zip through as many as we can. First up is we've just finished a development cycle that's produced 3.7 million square feet of new supply since 2021. Will we see a new office tower kick off in the next 3 to 5 years in downtown Vancouver? Jarvis, you want to start?
I believe so. But just like to outline the economics of a building right now, you're between $900 to $1,100 a foot, including hard and soft. So say $700, $800 a foot for hard, including increased TIs and things. Then you got $200 to $300 of soft, including raised interest costs and things like that. So if you're at a $55 net rate and you're capping it at the old cap rate of say 4%, you're making maybe a 10 to 15, maybe 20% profit on costs. So your risk-adjusted return is nailed. If cap rates go up to 5, which they may even go a little higher potentially from what we've been hearing, but while interest rates are up, your profit's completely wiped out at that same rate. So I think what that tells me is rates for high-quality buildings are going to continue to go up. But I think in terms of my answer to the question being yes, I think there will be, and it will either be a build-to-suit by a large corporate tenant that's looking to, now that they've finally figured out exactly what their staff and their culture is going to be, and they want to build exactly to their ESG standards and otherwise. I think that's going to be one, or it's going to be, to Kevin's point, as he said earlier, it's going to have a significant pre-lease component to it. But I do think that's going to happen.
Janay?
Yes, but it'll be smaller. It'll be smaller buildings. Nothing massive would be my.
Kev?
Yes, and someone should, because there'll be such a rapid absorption on the backside. So if you're building now, you've got 4 years to go. You're gonna drop right into a moment when you'll be the only large floor plates in the city, or large blocks of plates in the city. So someone should go sooner.
Last but not least.
Yes.
Okay, thanks for that. I want to talk about WeWork briefly. There's not many companies that have garnered as much attention over the last 10 years. They went from a $42 billion valuation. I think they're sitting at around $120 million today. So what is the future of WeWork in the city of Vancouver? Because maybe you have to pass, Jarvis, but Glenn, you want to start on that end?
Sure. I think WeWork makes it out of this whole thing. I think there are going to be some winners and losers on the landlord side. I mean, there's already been a case where Bentall has taken the space back from them. But at the end of the day, you look at the product they deliver. Forget everything else, right? You ask anybody who's in a WeWork, they like being in a WeWork, right? It was too big, too fast, and they're working their way through a lot of that throughout North America. But I think that it will be a long period of time, but I think they're going to make it through all of this. And I think at the end of the day, we could be sitting here in 5 years from now, and they could be at the same size as a Regis is. So I think they make it out.
Yeah. Listen, that segment of market needs to be fulfilled. So if they don't make it, which would be a shame because they literally carried the weight of return to office and COVID uncertainty for employers, that the landlords should consider if it's in your portfolio. There's 4 of them downtown that you need to continue to find an operator for it. It has a function which is important.
I don't know if I have much to add, but if they don't make it, we have wonderful co-working options already. As someone who was in a Spaces for 3 years, I can't speak highly enough about it. So I think the co-working model will always be there, whether it's WeWork or these other groups that infill if they go.
Can you speak to it?
As a landlord for a WeWork, I will be careful what I say, but they've been a great tenant. It's an extremely successful location for them. I think it's one of their most successful locations in North America from what we've been told. It's a strong performer. You walk through there today, it's packed. So to Glenn's point, I think people who are in WeWorks like it. To Janay's point, if they don't succeed, and I think they've got a lot of work to kind of work through a lot of the bad contracts potentially across North America that they've got to try and maybe unwind to make it work. But if they can get through that, they will succeed. If they do not, there are other that model will work, and there are other structures that people are out with in terms of co-working that will offer different options to landlords. But there's no doubt that service, that space as a service, is not going away.
Okay, great. Office to residential conversions. Does it have legs in the city of Vancouver, and will it make a material impact on vacancy to Vancouver? Do you want to start?
Sure. Vancouver, I don't think will be as impacted as other cities. I know a lot of cities in North America are calling Calgary municipality right now because of their incentives, which is working. I mean, they've had such a glut of office vacancy for some time. It's great to see. I think there's an interesting conundrum there with the taxpayer kind of funding something that was caused by city zoning and private investment into office, building just the downtown core with no residential. So that's an interesting discussion, but I think cities can do other things as well rather than, as opposed to funding cash from the taxpayers. One of the things, if we were to do it here, you'd have to relax energy code, you'd have to relax seismic code. There's a whole bunch of tools at the toolkit that they could do to make it much easier, and I don't think if they don't, I don't know if they're looking at that. I don't believe they are at this point. But for it to happen, those types of things need to take place.
I don't think it works. I think it's too expensive in Vancouver, and I think things would have to get a lot worse before we're really looking at it. The Calgary model, I was told that out of the plethora of buildings that they had to choose from, there's like 5 that work when you actually look at the way it's structured. So I don't know. I don't think it has legs.
Calgary's actually got 13 projects going at 2 million feet, drop in the bucket for their problem. But we've done it in the city, right? We did, was it the hydro building on Burrard? We did the West Coast Transmission building down Georgia Street. So it's been done in the city before. Calgary pays the developers $75 a foot as an inducement to do it. Back to your point, I don't know that the city of Vancouver would get behind it the same, but it is a fantastic way to avoid, I see Sunny's in the room, we've got energy and carbon efficiency criteria that's showing up in 2026 and 2030 that's going to further obsolete older product, so it might be a good go-around to get to higher and better values.
Yeah, I don't think that there's no chance that that happens. I mean, think of how long it takes to build an office building in this city, let alone convert an existing office building into a residential building. I can't see a scenario where it happens. And to Kevin's point, if vacancy is as high point today and we're going to eat away at it over the next 5 years, you know, those buildings, in order to convert them, have to have a significant amount of vacancy. The issue with our C and B class buildings is that there's not a sizable tenant within them. There's 50, 100 tenants within them. So you got to have a lot of people leave that building before the landlord can actually even get control of it to get to that point. So I just don't see that happening. And in fact, I see quite the opposite happening. I think, you know, we might end up in a situation where those buildings eat away at their vacancy and they end up at a 8%, 7% vacancy, and they continue to thrive. Although they should be converted.
Yeah, but
to
we've
something
done it
different.
before.
We have.
Fact. And secondly, I mean, aren't we blaming education right now, post-secondary education, on the housing crisis? Like, there's a lot of hotels get in the way. We're Airbnb restricted now. There's a lot of reasons why we would drive more will at creating more housing.
But you got to have a building that's vacant or clean
Hey,
air
people
vacancy.
people do line up leases with termination provisions for developments all the time.
Okay, we got 3 minutes and 2 more questions, so let's just keep these quick. As a percentage, how high will vacancy get in 2024? Jarvis.
Oh, God, I gotta be the first one to answer this. What's it at? What did you say? 11.8% is what it's at now? Are we talking availability or vacancy?
Vacancy.
So vacancy is what? 11%. Still go 11? I think it's going to go up maybe 2 to 3 more %, and then start coming down.
Janay?
I'll let the brokers talk numbers. I'm not going to guess, but if B class and C class landlords continue to improve their space, I think those spaces, 3,000 square feet and under, are going to get absorbed. If you haven't touched your space and you're just thinking about it now, you're going to be 2 years out. So I think they're going to get absorbed if you're improving them.
Yeah, I'm more optimistic. Return to office is the thing, and I'm going to say that we're peaking into the low 13 range.
And I'm even more optimistic than that. I think if we sit here in 2024 at this time frame, I think we're actually down in vacancy.
Okay, great. Well, that dovetails nicely into my last question. And Janay, I'll start with you. As we look to 2024, what are you most optimistic about in the office market in downtown Vancouver?
I think B and C class buildings, reinvesting in their buildings. I always use the Marine building as an example, Andrew. 10 years ago, they had this older asset and they reimagined the branding, the story. They doubled down on the Art Deco history of it, and it told a story and it put them in a totally different class. And so I'm excited to see, as this market that gets tight, landlords have to squeeze every ounce of cool factor out of their buildings. And so I hope we start to see more of those repositioning of these older assets, because it's sustainable, it makes sense, and it sets them in a different asset class. Yeah.
Kev?
I love that it is no longer just a seat in a square foot. It is an experience, and that was what COVID has taught us in the moment of uncertainty with return to office. And the investment by landlords and employers is awesome for all of us who get to enjoy it daily.
Glenn?
We've seen such great movement in our market in the last, call it 1 to 2 years. And it's, when vacancy is at 2.5%, you can't move. So you renew your lease, and a lot of those leases that are renewed are older improvements that they're just living with. Today, a lot of those tenants have moved to beautiful space. And it's really nice to see the actual fully built out, improved space. And I think a lot of employers are a lot happier.
Last word to you, Jarvis.
I think when I look at it through this lens, just like culture-wise, I think tech was ahead of its time. And I think our industry and others are catching up in terms of just bringing people back to the office has allowed, one of the things that we've dealt with is, people couldn't be themselves in the office. Yeah, everybody was wearing navy suits and black suits. They had to hide their tattoos and their nose rings and this and that, the other thing. And I think now companies are realizing if we're going to entice people back to the office, let people be who they're going to be. in the office. They can't just hide that. And I think we've dealt with that, and I think I've talked to other people with other stories. It's been way more prevalent now. If you're going to come back, be yourself. Dress, the casual dress thing going down has been one of the best things of this whole point, a small one. But I just think it's great. Cultures are now moving forward and catching up with tech where people can come to the office and be themselves.
My husband went to his office the other day and they had puppies in the office. Puppies. And you could take one back to your desk if you were in the office. Like, CEOs are throwing everything against the wall right now.
Well, thank you, everyone. Thank you to our esteemed panelists for the discussion this morning. That concludes our chat. I think, Paula, did you want to come say a final word?
Thank you, Andrew, for being a fantastic moderator, and thank you to our esteemed panel. I mean, what we're hearing is, yes, it's a little scary that we're, for Vancouverites, that we're in double-digit % vacancy-wise, but relative terms, we are still leading the pack in North America, so it looks like the place to be. So yes, huge thank you to Andrew, Jarvis, Janay, Kevin, Glenn. These panels, we so thank your time and effort in prepping for them and the lively discussion. And as always, we want to thank this morning's featured sponsors at the platinum level: Anthem Properties Group, Avison Young, Beatty, Bosa Properties, Cadillac Fairview, Cushman and Wakefield. At the gold level, Bosa Development Corp, Concert Properties, Concord Pacific, JLL, McCarthy Tetro LLP, Turner Construction, and at the patron level, Nicola Wealth Blackwood Partners, Downtown Surrey Business Improvement Association, Lee and Associates, Morgard, Remax Commercial, and Wales McClellan Construction. And thank you to all of you for joining us this morning and spending your morning with us. We look forward to seeing you next Thursday at our fall cocktail event on November 2nd and November 16th at our next and final breakfast of the year. So take care. Thanks so much.